So I want to start with one of the comments our guest from yesterday said, Lewis Johnson from Capital Wealth Advisors, and I want to see if you agree and maybe your process is somewhat similar. He says he usually starts with gold. Gold is the smartest person in the room. It always leads the way. It's always telling us something. So do you emphasize a lot of your research on gold and its interplay with other asset classes, and if so, what is gold telling us right now?
Oh, absolutely. The key thing to start with facts, that's what we try to do in Bloomberg Intelligence, then explain, is the fact that every major risk asset on the planet's underperforming the rock this year is not a good sign. And with crude oil dropping 15%, that's never happened to the extreme we're seeing this year. Maybe we'll get lucky and get out of this, but it's an ancient store value that's supposed to be a store value. It's not supposed to be alpha, as our speaker spoke about this morning. So look at price of farmland in Iowa. I used to own farmland in Indiana. 4 ounces of gold over time, spiked up to around 8 for a little while, gets around 2, right now around productive farmland is 4 ounces of gold. S&P 500, typically over time, historically, it was like 1 ounce of gold. It got a little expensive in 1999, 2000. Just recently, the high was 2.6 ounces of gold. Right now, it's 1.71 ounces of gold. The key thing to remember over time is you take that S&P 500 total return, divide by gold, it always goes up. It should. So what does stocks do? What does the stock market do? It's human nature. It's human intuition. It's humans creating more with less in earnings and value. But that trend stopped in 1997. The price of gold versus the total return of the S&P 500, the thing that you see on CNBC and Bloomberg and CNN all the time, you don't hear about gold that much, is flatlined since 1997. So over that period, it's been the same. That's not a good sign. So I look at this year as we get towards the year end gold has been great. I've been bullish forever. But the key thing as a strategist is you got to get beat up first. It can't be easy. So I got really bullish gold for a while, but certainly in 2000. Biggest money pump in history. And because it pumps up to 2000, and I stayed bullish gold for 4 years, and it took till 2024 to break above that. So, but now we're getting expensive, and it's where you want to go from there. But yeah, it's the store value, and I'll end with this. Right before I came over, the Bloomberg Radio, which is part of the fun part of my job, I'm a strategist. And once in a while, they like me to talk about what I write about, which is all I do here. They wanted me to talk about Bitcoin, because it just dropped to 100,000. And the key thing I've been watching forever, I love watching that Bitcoin to gold ratio. Right now it's about 26 ounces of gold per 1 Bitcoin. I started watching it when it was 1, and it's heading lower, which is bad for risk assets and typically good for risk-off assets.
I want to circle back to Bitcoin, but let's just stick with gold for a second, and silver. You were correct in anticipating that gold would go over 4,000, which it did. Silver over 50. We know they've pulled back a little bit since then. And you alluded to oil. You've been, and I get your morning notes, you've been calling oil visiting 40 before it visits 80, and it's heading in that direction, has been. And you also point to this, the largest ever annual performance gap between gold and oil, which is saying something. And so one of your overall theories, concepts, is post-inflation deflation. So wrap that up for us.
Well, it's a fact. So let's start with the great Canadian I consider a friend, Jeff Booth. He wrote the book, The Price of Tomorrow, and pointed out how technology is happening so fast. You can't keep up. It's inherently deflationary. Your average person in India can get one of these for $12 now. Where's that going? So that's the key thing that really, and there's another thing, another book that really shaped my views. Sometimes about reading the right, or listening to the right books. Another one was called The Price of Time by Edward Chancellor, just pointing out what's happening in China. And every single time you get a big pump in liquidity, a big pump in risk assets in history, you always get the flush. Now that's happening in China right now, clearly. And I just don't see what's going to stop it from trickling down. So let's just point out facts of what that deflation that's happening in China. And that is PPI is running minus 2 to 3% for a couple of years now. 10-year note bond yield's 1.8%. In Canada, it's about 3.8. In the U.S., it's just above 4. That's despite the fact that they're running debt to GDP around 300%. It's based on some analysts from Goldman Sachs. And money supply is running about $45 to $50 trillion. That's double the U.S. So they're doing just what Japan did 30 years ago. I traded Japanese government bonds in the 90s, and I just remember it well. Somewhat jaded by that, I guess. But the key thing I want to point out, part of the reason I mentioned those is when crude oil popped up in 2022, because of Russia's invasion of Ukraine, it just triggered all the books I had read. Another one was called The Domino Effect, just about how the shale is just kicking in. What is this? To me, my big takeaway is just technology is happening so fast. Every vehicle we drive uses less fuel to get to the same destination, and we create more with less every day. So I thought, okay, that's going to fuel the correction towards 40. I've been wrong. Initially, I had to get thrown down on a mat and be called, you got to be called an idiot for a while. But I stuck to my guns, and now we're trading $59 a barrel, and it's a consensus, which concerns me. But a lot of the traditional strategists and analysts did not get the shift, and that's the key thing that I always try to do is, the questions are the same, but the answers have changed. And to me, that answer changed. It just accelerated that technology revolution. Now we see BYDs everywhere. The Chevy Volt I bought in 2011, which is you can get that same vehicle if we didn't have tariffs from China with 3 times the efficiency, and it's half the cost. That's unstoppable. So to me, it's the process of technology replacing fossil fuels accelerating. I see it. I love to go to conferences. I go to agriculture conferences, particularly in the U.S. Midwest. And everything they say to me is, Mike, we can't keep up with the technology. So to me, that's the key thing that's pressuring. I put that whole space in terms of commodities in one area. Grains, corn, soybeans, wheat, crude oil, energy, even natural gas. They're all in that space. We're creating more of it less. We use less. We still use natural gas, but prices are going lower. They're in a bear market. That's deflation. And then I switch over to the metals. That's where we have the bull market, led by gold. So I still think crude oil is not going to bottom until it just simplistically is going to do what it's done for the last 20 years. It's got to get below its break-even cost. Anybody's ever read Adam Smith's? You got to get The Wealth of Nations, and typically supply and demand. You usually got to get below a break-even cost to reset excess supply and demand. That's been $40 a barrel for the last 20 years. Well, has that changed? The average cost of producing crude oil in the U.S. is around 55. I think it's about the same in Canada. So you got to get below that, unfortunately. And that's what this year's low is. So then I also look over, that's not the elephant in the room. The elephant in the room is if crude oil is down 16%, and a year that the stock market's up 16%, what happens when the S&P 500 drops a little bit? So that's why I have to tilt over. A lot of what I think gold is doing is figuring out that we are on late stages of a significant bull market. Everybody gets it, just a question of what you do about it. And gold gets it. And to me, that's what's happening. So to me, the next big trade is going to be when we get a little bit of reversion. A lot of people will say, McGlone, yeah, you've been saying that forever. And yeah, I'll admit that. But I found great alpha in cryptos. And then to find alpha in gold a year ago was kind of scary, but it worked. Now where's the alpha? And I view it's more deflation for inflation. And the number one source for inflation on the entire planet now is the U.S. stock market. Highest ever versus GDP. Well, highest since the 20s, late 20s. Highest ever versus the rest of the world. And it just recently started tilting down versus MSCIX. U.S. index certainly rolling over versus gold. And the only thing that's left is the U.S. stock market versus GDP. So when that rolls over, it could be now or it could be a year from now, who knows? That's normal deflation. So I think when that happens, I like to say, when people have a view on industrial metals, they say, well, if you're bullish, you got to be bullish U.S. stock market, because if it reverts a little bit, that's going to happen. So to me, this is what's happening. And it's when, and all the signs are there, particularly with gold. And you know what the tip of that iceberg is? And we can get into it deeper later, is cryptocurrencies. Why? Because there are millions of them, and there's no basis. Most of them track nothing. And our president is now has a vested interest.
Right, so that brings us back to Bitcoin, which often leads the way on the way up and leads the way on the way down. And heading into today, it was down 18% from its peak. It's up today, but we're also seeing Strategy, formerly MicroStrategy. That's really rolled over, so that strategy has not been working lately. And so that's performing poorly. Are there any similarities to what happened in 2021 when we had that so-called everything rally and all risk assets peaked in, I guess it was November of 21?
Yes, there's a significant rhyme. So I love MicroStrategy. So anecdotally, first, the anecdotes sometimes are great. I have sons that are adults. And I have 2 fathers I met last year who asked me the same question. Mike, my son's invested in MicroStrategy. Would you tell them to sell? I was like, whoa, I've never seen that before. I mean, never heard of that before. I've been in the business for almost 40 years. Like, okay, this tweaks something. So I've been watching. MicroStrategy it's just basically leveraged Bitcoin. And I got to meet Michael Saylor. And just like this, I interviewed him 2022 in Miami. It was the first coming out, like a event for Bloomberg. And they said, hey, Mike, you're in Miami. Go ahead and interview anyone you want. I chose him. I enjoyed it afterwards because most of the crowd had never heard of this type of stuff. And he was very bullish. But the key thing is he picked up on a great trade when it was around 10,000. He got a 10x. And one of the lessons you probably all learned, I see a lot of people who have a lot more experience than me, I only bow in your general direction, is you never mess with the market gods. So it went up 10x, and he doubled down. I'm like, oh, man, I've seen traders do that in the pits. And then I hear about them getting divorced or committing suicide. And it's sad, but it just happens. You never double down on the 10x, but he did. And that's what happened. So far, that market started rolling over. The 200-day moving average and MicroStrategy just hilted over. The market can rally 10% and still in a rolling over 200-day moving average. That's what happened in 2021. You look for the high beta, high volatility stuff to lead the way. It's leading the way. Now, Bitcoin just broke below its 200-day moving average. It's bouncing right where it's supposed to at 100,000. And why are we talking about it? Because this is the tip of the iceberg of risk assets. And now it's in the mainstream. So what's happened since Trump got elected is he pumped it up. It's just a free for all, and there's been a pile on. And so the people who were in it before, some of us who got in it early, and many X's are looking at it like, okay, this is a great way to get out of the system. And now if you're buying cryptos, if you're a pension fund and endowment, which are typically not Trump favorable, you're supporting the Trump administration. Sorry, but it's just a fact. They're heavily invested, and you're dependent on them. And now retail's piling in. It's a classic sign of a peak. So I think the whole space can drop 90% easy. And here's one thing I enjoy doing as a strategist. Sometimes you have to, as Frederick Douglass says, you have to agitate. It's just our duty, even you as a journalist. So you got to agitate. So in 2018, I said, yeah, Bitcoin's around 10,000. It can easily drop a zero. Got a lot of hate mail. And guess what? I was wrong. It dropped 70%. So I got 70% right. It went down to 3,000. I just published the same thing starting a few months ago. I reiterated it. I still think it can easily drop a zero. Now, if it goes to 30,000, a lot of people will freak out. So I just published today the 48-month moving average, which it always goes back to, is at 56. And it's the most highly correlated to the stock market ever. Everything now on the planet is more highly correlated to the stock market. So I like to ask anybody, like I was on an energy call recently, and they're all talking about being bullish crude oil. I'm like, okay, so you're bullish the stock market. I'm like, what are you talking about? Like, just look at it, to put in your value at risk model. Take the S&P 500 down 10% in a week. What does that do for a month or a year? Doesn't happen anymore, right? That's when things start happening. Everything that's highly correlated will drop 20%. Just even bond yields, it's just so significant now. It's all that matters, unfortunately.
Your email this morning was a little bit ominous. You were talking about Bitcoin, and you made some comparisons to 1929, 1999, 2007, the Tokyo real estate, or the Japan real estate bubble and bursting of that. So what analogies were you drawing there? So
I have to admit, that's it's repetition is reputation. That's some things we say. I've been repeating that one for too long. And I do like Andrew Ross Sorkin's book, 1929. I dug in that area too much. But I fully expect the crypto space is like 1929. The whole thing can drop in a few weeks and make the whole difference. But it's just I was reiterating what I said. So right now we're at a complete inflection point. When Bitcoin was making new highs, and I said, yeah, it's going to easily revert to 100,000. That's the key pivot. And the VIX is going to pop above 20. And then I had to put that out and see how I got the responses I got. And they were all negative. I'm like, perfect. That's what you want to hear. When everybody agrees with you, you're never right. It's a lesson I learned in the trading business. When you call up 7 customers, you have a great idea, and they all disagree, you know the trade's going to work. I mean, that was 40 years ago. So it's happened. We've reverted to 100,000. Good fact is now we're at the end of the year. And so if early in the year, you were up 30% in Bitcoin, and the Bloomberg Galaxy Crypto Index was up 30% just a month ago. So you're a trader. You run leverage. You're up 30%. You know, Christmas is coming. You want to buy that G.I. Joe with the Kung Fu grip for your kid for Christmas, right? You're hitting stops now. And now the Bloomberg Galaxy Crypto Index is down 5% in the year. Okay, is it going to recover? Sure, maybe we'll get lucky. But the key thing I like to point is every single time is now we have a market that's the most highly correlated stock market ever. It went up with that stock market. It's going down ahead of the stock market. But the key thing that's different from any time now is S&P 500 90-day volatility is at 10%. It just recently bottomed at 8.9%. That's the lowest in 5 years before COVID. So you have to hope anybody who's getting long any risk asset now, cryptos, industrial metals, copper, aluminum, has to be hoping that stock market volatility stays inordinately low, at a very historic low. You have to look for that new lower plateau, say the opposite of what Irving Fisher said in 1929, a new higher plateau. But to me, that's the risk. And I started in the business in 1988. I started covering nights. I started covering Japanese clients. Remember it well. And it all blew up. I remember running around that Imperial Palace in 92 when it was worth more than the state of California. I mean, that's what cryptos are now. They're just silliness of a bull market. The number 9 on the Bloomberg crypto page, CRYP, is Dogecoin. It was launched as a joke. It means nothing. It's worth $24 billion. I enjoyed writing about that last year when it was worth $50 billion because it's the same market cap of BNY Mellon, the oldest bank in the U.S., founded by Mr. $10 bill, Alexander Hamilton. By the way, BNY Mellon has $19 billion of gross revenue. It's silly, but this is the thing I'm worried about. Here's the way I want to end with is, I can't wait to write the book about it sometime, and my book's going to the title's going to be something like it was different or it wasn't different. And I'm kind of going with it wasn't different, hoping to tell the story.
So the VIX is under 20. It had a spike a while ago, but it's under 20. Do you think investors are complacent, number one, but also tie in retail mania and meme stocks and 0 days to expiration options, which are now predominantly the most traded on a daily basis. So investor behavior now compared to other periods that you've seen.
It's negative gamma is the most powerful force in markets. Now, the rate of change, I'm used to being an option trader. Rate of change, delta is your position relative to the market. So if you have a 50 delta, it means the market goes up 10%, you go up 5%. But it's the rate of change of that delta, negative gamma. So when you're short puts or anything that's short like options are, it's that gamma that kicks in from, say, yeah, I wasn't that short, and it gets shorter and shorter on the way down. But that's always what happens, and cryptos are kind of like that right now. We're seeing more selling as we go down. And there's little bounces, like Bitcoin has to bounce from 100,000. It's what it does when it rolls over. But to me, that's the key thing that happens. We're an extreme example of bull market and everything. Cryptos are the epitome of it. We all know it. We all get it. We've seen it. But it's what you do about it. So I really enjoyed some of the anecdotal. Like my colleague I sit next to, he's 40. No, it's great being 40. I remember being 40. And I told him the other day, I was saying, yeah, I was lucky enough to get cryptos a couple of years ago, got on top of that board, and now I'm jumped off the horse too early. You just could see where it's going. And then to switch over to gold last year, now it's like gold is just too expensive. Just be very careful. When it stretches 40, 50, above, 2 to 3 or 4 standard deviations to see what the cool people say. I just say it's the highest versus a 60-month move average since 1981. You got to be very careful. So now I'm just at a point where I've taken off my fundamental hat, was bullish gold, and put on my risk management hat. And I look at it as if I'm at a desk, used to work at a hedge fund, and there's 4 or 5 traders, and they're all long gold. I say, you better take some profits now. And by the way, I'm taking out of your bonus if you lose money from here. This is what you have to say. This is the way. It's generally don't go up that much from these levels. So I was on a show the other day, and I got lucky enough to call for 4,000 gold when it was at 3,000, because you could just see what was happening, right? That was a few months ago. And he wanted me to call for 5,000. I'm like, I just can't do that because it's so stretched right now that it's just plain frightening. And I had to say that around Halloween. This doesn't happen in the world's store of value for no reason. And with crude oil going down, so here's my next iteration. Right now, the S&P 500 is up 17% in a year. Wonderful. Nate, it's basically the third year in a row of up 20%. That's basically what happened in late 29. It's what happened in, remember a lot of us in 99. 7 was a little different. It's happened in Japan. The average for the last 20 years, or since the beginning of 2000, is 10% years. I mean, that's awesome. 10% total return. Just imagine if we end the year up 10%. It's cascading dominoes. I mean, it would be horrible to end up 10%. Oh my gosh, 10%. But that's my point. It's that time of year. We can't, maybe we'll get lucky. Maybe we'll get through this next few months. But just happened with Bitcoin rolling over and cryptos. I just sense that's a liquidation market now. People are figuring out they bought the wrong thing for the wrong reason, and it leads everything.
And what about silver? It finally got through 50, got to 52 and change. It's pulled back since then. You said that usually it catches up to gold and outperforms. It hasn't really done that this time. Why do you think that is? It being treated more as an industrial?
Demand pull, most notably on a global basis and from China, volatility in the stock market going lower. Typically, silver outperform gold. It's known as the devil's metal for a reason. I traded too much of it and I lost my hair. It basically trades 2 times the volatility of gold. So when gold's up 10%, silver's supposed to be up 20%. Now today it's doing okay, but the last 2-3 years it's basically just lagged completely. All the PGMs, all the metals. There's 4. I love to say there's 4 precious metals, and there's 25 million cryptocurrencies. So I love a basket of precious metals. There's an index that tracks. I love to write about them. But the thing about silver is. It's more of an industrial metal every day. It's been demonetized by gold forever. We have 200, 300, 400 years of data, and I love looking at gold-silver ratio. And I was sitting at a panel like this in February in Miami, and the gentleman next to me said, oh, it's going to mean revert. I'm like, yeah, as long as the stock market stays strong and volatility doesn't go up. And the exact happened. So silver gold went to 105 this year. That's the high. And it just dropped down to about 80. Now it's running around 82, dropped around 79. That's been good support for a while. I'd love to see it close below that level to show yes, maybe there's demand pull coming out of China. We all know what the demand is, solar panels, electricity, and everything. But central banks ain't buying silver. They're buying gold. And they've been buying gold. And the whole world knows what silver can easily bring it out of supply a lot easier. That's the reason the world's gone to the gold standard. So I'm really concerned that you look at the last couple hundred years, the highest silver gold ever ended on the year was 90. In 1990, 91, it was around 90. And then 2020, it was 90. That was both recessions. And right now it's about 82. So that's good. It's coming back a little bit. But prerequisite for that market to not go higher is you got to look at that VIX volatility index. By the way, I'll mention that too. No, first of all, 90-day volatility is about 10%. That's actual. VIX, the 200-day moving average, is running around 19. And by the way, it's been an up bull market, 200-day moving average of the VIX since President Trump was elected. Quelle surprise, right? En français, quelle surprise. And so it's got to stay lower. I'm afraid that this index, this ratio, which we don't want to go higher, is more likely to go higher with just stock market volatility mean reverting a little bit into the year end. And then what are the dominoes into next year? So last year was great. We had the momentum into the year end, right? Everything was going up. Trump was elected. He's going to make the world great again. But he failed to mention that he has the timing potential as Herbert Hoover. If you just look at the valuation of the stock market, it's the last time it was this elevated on a global basis. And nowhere near as expensive it is versus the rest of the world, but I mean versus GDP. So I'm just worried that we're going to get that, at some point, that reversion. Gold's telling me that. Crude oil collapsing telling me that. And crypto's turning over, and if Bitcoin breaks 100,000, there's your final signal that dominoes are going to tumble into the year end.
What's your thought on copper demand and the price action and how it fits into this scenario?
So I love sitting next to my colleague Ken Hoffman over here because Ken and I go back at Bloomberg forever, and Ken goes in the mines. He digs in. I'm a macro guy, and more from a financial pits background, futures background in agriculture. I used to own the farm. And when we were talking about supply and demand, he said, yeah, it's kind of a similar thing. I remember hearing that in 1991. That's a key thing. What is not known about increasing demand for copper? We all get it, and problems with supply. It's a known. We all get it. It's in the price. Right now it's $5 a pound, about. And so I put on Outlook recently, the problem with copper now is if you're bullish copper, at least in the short term, long term, we all get it. It's harder for me to predict. You better be bullish the stock market. If I look at it being, running leveraged money, if the value at risk model is going to, it might not be right, but it's telling you if copper's at 5 and S&P 500 drops 10, 20%, copper's going to 4. And what's it going to take to go and stay above 6? Well, first of all, you have a little bit of demand pull out of China. Something has to shift. And by the way, I heard from, the last 100 years from an economist say if you wanted to become wealthy, you cozied up to the U.S. Well, they did that well. Shut that off. At least Mr. Trump did. So good luck. I pointed out severe deflationary forces in China. Yeah, I get the solar panels, but it'd be nice if I can buy those cheaply in Connecticut. Well, I bought those then. But to me, that's the key thing about coppers. I'm worried about it. All that matters now is, first of all, to be bullish copper, have to assume the stock market goes up. I'm sorry, but that's just the way it is. I've got data going back decades on this and point out it's almost the same trade until recently. Last 2 years, the stock market's taken off. I mean, you can take the price of copper, overlay the S&P 500, divide by 1,000, it's been the same trade for 10 years. And then just recently, the stock market took off. Also, you can overlay the price of copper with the U.S. 10-year note yield. And so here's another thing I worry about coppers. Copper's companions, typically iron ore, heading lower. Bond yields in China, heading lower. Crude oil, heading lower. So what's going to happen if the stock market drops 10%? Copper's going to join its normal companions. For it to go up, that would be great. Again, the bottom line is prerequisite, the stock market has to keep going up.
As far as critical minerals and rare earths, we've seen the likes of MP Materials scream higher, although it's come back quite a bit. Ucore Rare Metals, another one, has done extremely well, and again, pulled back a little, somewhat. How do they fit into your framework, those two?
That's more the macro. My colleagues will follow it. And the key thing for me is I'm bottom line background futures, so underlying commodities. This is where the underlying commodities going and why. And those are mostly, to get exposure, you have to be involved in the mining and the equity. So I don't really follow them so much, but one thing I have a sense from my colleagues, and certainly from here, is there's an underlying support factor in all that, certainly in U.S. miners, related, because of this current administration. And it makes sense to reshore. I mean, China crushed it. Good job. It's a global capitalist system, and they gained their dominance, but it's time to catch up and say, yeah, they're kind of critical, we need them. So I see an underlying bid in those equities, but I'd have to just point out, I can't come on too much unless I only really feel strong about things I published on the terminal. And it's been vetted by those thousands and thousands of people who read it and who criticize it, which is what I need. To make it better, you have to have good, smart professionals. I just don't,
okay,
too much.
Fair enough. When you were actively trading compared to now, how much has changed? I'm sure a lot, but what's different?
Well, one thing, I started trading the trading pits, and I love being on the phones. I never was a trader. I actually had 3 brothers who traded. I was always on the phones talking with clients, like people in Canada, and mostly a lot of London traders. And they educate you. It's just so good. When you mess up, you're toast. But the thing I really enjoyed is, one thing that's the same is human nature. It's never going to change. And it's the hubris of getting really bullish near highs, like our presenters pointed out this morning, what I see happening in cryptos just a few months ago, and the disdain and pain getting near lows, and trying to determine those peaks and valleys, right? And so that's one thing that hasn't changed. But what's really changed, obviously, is no more trading pits. I love making the analogy between born and raised in Chicago, last 30 years in New York, Connecticut, and then now in Miami, the American Exchange is opening in Miami. I go back to Chicago, the exchanges are gone forever. I mean, that business, technology has moved so fast. So that's one thing that's changed. When I see trading, for instance, like in cryptos, that's bot heaven, algorithm heaven. You create the bot, the algorithm to trade, and kind of program it, and plausible deniability when you're wrong, right? Who programmed it? So to me, it's all bots. It's so much of that electronics, but it's still the human nature will never change. And that's one thing I love writing about. It's the key thing I have to point out as a strategist is trying to acknowledge human nature, trying to determine inflection points, determining when the answers have changed. That was a key thing but I had to hit hard in crude oil and had to take the pain. But now we all see that the answers have changed. The world's changed since Russians invasion Ukraine. Copper is going to have a big test. This year is a great test. It's up for the wrong reasons, right? Because of supply constraints. Is there demand pull from China? Not really. Is there demand pull from the rest of the world facing unprecedented tariffs from the world's largest demand pull source? No. Okay, how long is that stable? So that to me is the thing. But as far as the actual trading, it's just so much more electronic, so much more bot driven. And so I remember when you'd hire a trader. We started hiring electronic traders, and I remember it was like 20 years ago when Globex came out in Project A. I think it was Project A at the Board of Trade. And I remember the first question we'd ask some of the 20-somethings is, did you play video games? And I loved the answers, because a lot of oh man, yeah, of course I did, but am I supposed to tell them yes? And we'd always say, I hope so, because if you trade video games, you have the quick trigger finger. You needed that now. That's just the way trading is. And it's much more the programmers who do it, who get information from AI how to do it. So I just try to understand what I don't know, and there's a lot there. I just try to acknowledge it. Yeah, this is so electronic, so out of my realm, but the human nature will never change.
And is the vast majority of that commodities trading day-to-day, short-term, or is some of it long-term?
Well, that's the key thing I love being in trading pits. You've always heard about high-frequency traders. In the trading pits, it was one bid of two, one bid of two, two bid of four, or three, two bid of three. You play the flip. Most of the locals just played the flip. They provided the liquidity. Some of them took a position. Most of them went home flat. Let's see what's happening now with high-frequency trading, but it's more seconds, you know. And I mean, I love reading that book from Michael Lewis, Flashpoints, but I think he was missing the point. We need liquidity providers. It's so important to have traders and speculators. They got to have those people to provide the liquidity. If not, you just have massive gaps. But now it's just all electronic. But I just remember one bid of two, one bid of two. Mike, and you talk to locals and you ask them what they do if they hold positions. No, just playing the flip. But the thing is, you could see the flips. And I remember that you'd ask your guy, I'd be on the phones, and my clients would ask me, hey, Mike, how's the pit look? And you could say, yeah, sometimes it pit's short. Why is it short? Well, because paper institutions have been buying all day, and you can just kind of tell. Locals have been selling into it a little short, and they're going to cover on the close, and they would. Sometimes you could just smell it. When it was a busy day, and it smelled like busy people sweating, and the market was going a certain way, usually meant by the end of the day I was going to kick in a little more, because it meant pain. And so that's the key thing that's different. But now it's just so quick and electronic. Less people involved, but it's safer because back then you could actually, and here's another, I'll end with this. If you can figure out where the stops were and the guys who held the decks knew where the stops were, then you know where to run. You hit the stops and run markets. And sure, there was some of that kind of activity going on. I mean, it's human nature. That'll never change. And now it's harder to determine the stops, I think.
Mike, are there any other market trends that you're seeing that you find compelling, intriguing that we haven't touched on?
Okay, let's see what happened. What just happened today, yesterday. Mr. Mondami won a landslide, basically, in New York. Now, I've done my 30 years of New York, so I got the politics well, just knowing what happens in the city with different mayors. And when I moved there, Dinkins was mayor. But that's a key, let's not underestimate the signal there. First of all, growing up and spending 3 decades there, is most people hate Trump. Just the way it is, because he's just so in your face. Like, yeah. But this is an indication of what's going to happen in the midterms. We all know it's a great check and balance in most of our countries, most notably in the U.S., is there's a self-correcting mechanism that Chinese just salivate over. They can never replicate unless they change the regime. The self-correcting mechanism in the U.S. is you always switch back at midterms. This is an extreme example that we know. I'm very high probability that we're going to switch. Trump's going to lose his majority at midterms. And then we better not get that normal recession we haven't had for the last 2 years. To come to the final end of the Trump term, that it might be the end of that type of extreme republicanism forever. Unless, if it works, he's fine. We end up on the Mount Rushmore. But to me, this key thing that just happened. And it's what it means. The whole population, just recently I saw the headline in CNN, the No Kings protests where 7 million people showed up. Yeah, okay, CNN, they're not always Trump favorable, but this is what's happening. It's just a normal thing that's why most of us in the States so wanted the Blue Jays to win, because you're the underdog and everybody hates LA. But you get sick of the party in power, you want a little flip back, and it's the American way to go tilt the other way at midterms. So what happened in New York is just an extreme example of what to expect in midterms. Something's got to really shift. And so here's another thing what I took away from that. It's a lose-lose for Mr. Trump. Because what is the number one thing, one of the number one contentions that got Biden lost the election, and when Mr. Mondami won? Cost of living and inflation. And what was that driven by? The biggest money pumping ever up to the peak in 2022. The rich people won. Anybody owning property won. People with condos in Miami, Toronto did fine, right? But your average person, 55% of the population in the U.S. are wage earners. They're still falling behind. They don't really care about the stock market. If Mr. Trump's the biggest cheerleader on the planet, the stock market keeps going up at 2.3 times GDP. It's impossible for inflation to go down. It is the economy now. It's just the way it is. And you see that happening. Mr. Powell finally said it. Yeah, we're not really supposed to be throwing, giving you the punch bowl when the party's getting out of hand. And so that, to me, is part of the lose-lose. Trump wants the stock market elevated. It's creating the inflation, keeping the Fed out of the picture. And just a normal 10% correction would be kind of really good. I was pointing out if you could just stay down for a little while, that might make things reset. And the Fed would ease, inflation would go down, crude oil would get cheap, which is probably going to do anyhow. But to me, that's the key thing that just happened that really hit my my radar. I think that's the inflection point of a bit of a lose-lose for Mr. Trump. The whole country is tilting away, just a normal cycle, love him or hate him, and he's going to lose his majority in about a year.
One more question for me, and then we'll take some questions. We have microphones on either side of the room. Put your hand up, please, and we'll get to you. So if the Republicans were to lose the House, would that even matter? Because everything Trump does is through executive order. He doesn't even deal with the House. Would they try to impeach him again, or?
Well, I hope not. I mean, that's just kind of silly stuff to me, which is get down and use our check and balances and let them work. I don't know, but the key thing I see is, like now we have Supreme Court decisions coming up, but I think it's the classic check on power that's kicking in, because this is a pretty extreme leader, and the lesson love him or hate him, I just look at this is what it means for the markets, and but so I have to think what's going to happen with markets, and that's the key thing I saw what flipped with cryptos is. Crypto market going down is a complete reflection of Mr. Trump. I'm sorry, because he endorsed it. His whole family, his son keeps saying it's going to go to $1 million, Bitcoin. His family's complete, and this is a Bloomberg story. So, to me, it's just part of what always happens with presidents. Their ratings come, and then when they get elected, they go high, and the ratings go down. But we have a good barometer now on things like cryptos. The problem is they're leading the potential deflation that I'm looking for from inflation that every lesson in history says we have. And the key thing is I haven't heard pushback on this. I love when I get pushback so it can really hone my views, that I still compare what's happening now to 1989 Japan was there. Worked for Japanese companies too. 2000 in the U.S., 2008 in the U.S., and then 1929.
All right, let's take some questions.